What if Nvidia isn't done surprising Wall Street yet? What if the company that built the backbone of the AI revolution is still undervalued? And what if Goldman Sachs is right, that Nvidia's next earnings report could rewrite everything investors thought they knew about tech stocks? Could this be the start of another explosive chapter, or is it just Wall Street hype before the fall? I'm Osama, and you're watching Stock Scop AI. Wherever you are in the world, if you want deep, data-driven insights into markets and AI innovation, make sure to subscribe and stay tuned. Let's dive in. In 2023 and 2024, Nvidia became the heartbeat of the AI economy. Every chatbot, every autonomous system, every cloud AI model runs on Nvidia's hardware. From OpenAI's ChatGPT to Tesla's training clusters, it's all powered by Nvidia's GPUs. And now, Goldman Sachs believes the story is far from over. According to their latest report, Nvidia could beat earnings expectations and raise future guidance, something Wall Street hasn't seen since the early AI boom. Goldman Sachs has lifted its price target for Nvidia to $240 per share, maintaining a firm buy rating. Why? Because of growing visibility into data center revenue and the rising global demand for AI infrastructure. Their analysts project Nvidia could hit $500 billion in data center revenue within the next few years. That's not a typo. $500 billion from one business segment. And the driver behind this growth? OpenAI's massive deployments planned for 2026, plus the rollout of Nvidia's new Rubin architecture. To understand what Goldman sees, you have to understand Nvidia's new empire, the data center. These aren't gaming GPUs anymore. They're the industrial engines of the digital world. Hyperscalers like Amazon, Microsoft, and Google are racing to build AI supercomputers, and almost all of them rely on Nvidia chips. Goldman Sachs raised its data center revenue estimates by 13%, citing new CapEx growth across the hyperscaler industry. In other words, the biggest companies in tech are spending more on Nvidia, not less. Goldman's forecast for Nvidia's upcoming quarters looks pretty strong. For the third quarter, the earnings per share is expected to be $1.28, which is about 3% above the Wall Street average. Moving to the fourth quarter, the EPS is projected at $1.49, 5% above consensus. Now, these might seem like small margins, but for a trillion-dollar company, they represent billions in profit. Investors are really paying close attention to Nvidia's compute and networking mix, the backbone of that $500 billion revenue forecast. What's really fueling this optimism is the AI infrastructure race. Goldman expects that OpenAI and other major players will deploy massive GPU clusters by 2026, meaning Nvidia's products are already booked years in advance. They've also adjusted their long-term forecasts upward by 12% on average for fiscal years 2026 through 2028. By fiscal year 2027, Nvidia's earnings could be 22% above current street estimates. By fiscal year 2028, 28% above. That's not just growth. That's acceleration in a market already dominated by Nvidia. But the question remains, can Nvidia keep this pace? Some analysts warn that expectations are dangerously high. AI hype has fueled massive gains, and any slowdown in orders or chip supply could cause a sharp correction. However, others argue this isn't hype, it's infrastructure. Just as the world once built roads and railways, today we're building AI highways. And Nvidia is selling the asphalt. Goldman Sachs believes we're still early in that journey. So could Nvidia shock Wall Street again? The data says yes, the market says maybe. And as the AI revolution deepens, one thing is certain. The company's building its foundation will define the next decade. This is Osama, and you've been watching Stock Scop AI. If you want to stay ahead of the market, not behind it, hit subscribe, drop a comment, and I'll see you in the next deep dive.